Let's talk about 30 things I wish I knew before I started investing. I'm going to work through these pretty quickly as there are 30 of them, but make sure you stick around for all of them as there may be some that you haven't thought of. How to emotionally handle FOMO and hype stocks. Don't just jump on something because everyone else is speaking about it. Things aren't always what they seem to be, and just because it's popular does not mean it's good. Finding an investing method that works for your lifestyle. For example, you could just set up a direct debit for once a month that just comes straight out of your account into your chosen investment and you don't even have to think about it. Finding an investing style that keeps you motivated and keeps you in the game. For me, I find dividend investing quite motivating, so I make sure to incorporate that into my investing style. Being aware of the impact of fees and expenses on your investment returns. If you're paying too much in fees, naturally your returns are going to be smaller. The importance of diversification in your portfolio for risk management. You can diversify in a range of different ways, by geography, sector, and asset class, for example. The long-term nature of investing in the stock market and the importance of patience and having the ability to get delayed gratification as opposed to instant gratification. To be fearful when others are greedy and greedy when others are fearful. People tend to prefer to buy stocks when they're on the way up, and that's when many people are greedy. So try and be fearful during these times. But opposite to that, people tend to not want to buy when the stock market is going down, and that's when some of the best opportunities are presented. The impact of inflation on your investments. The importance of having a clear investment plan. The importance of having clear investment goals. You can have smaller short-term goals that fit into your long-term plan. To understand the eighth wonder of the world, compound interest, and how this links into the saying, time in the market is more important than trying to time the market. How crucial it is to regularly review and then rebalance your portfolio if necessary. For example, you might be overexposed on one company and this may not fit into your personal risk management strategy. So you could look to trim back that position and allocate that money elsewhere. But there's lots of different ways to go about rebalancing. When to sell a stock. Sometimes taking a loss is okay. When not to sell a stock. Don't panic sell. How key it is to quieten the noise around you. Sometimes it's best just to ignore the news. How to stay investing when there's a crash. I learned this one the hard way in 2020 when I stopped investing when there was actually loads of opportunity. How investing in what you understand can be a very simple way to not overcomplicate investing. If there's a particular sector or a company that you understand more than others, then maybe just start with that. Also, ETFs and index funds do exist for the reason of not overcomplicating it for you as an investor. Understanding that some volatility and fluctuation is expected in the short term. You just need to zoom out and stick to your investment strategy. In any given year, there's something like a 33% chance that the market will go down. Also, there's about a 66% chance that the market will go up. And this is from data taken over the last 90 years. Understand that political and economic situations will impact your investments, and you just need to see the bigger picture. There's also the impact of currency on your investment and other costs like withholding tax for us in the UK investing in US stocks. Knowing that it's absolutely okay to get things wrong and make mistakes. We've all been there, we've all bought into hype stocks before. Trying to time the market perfectly will drive you mad. I find it mentally easier just to take opportunity when I see it, but not worry too much about timing the bottom of the market and then trying to predict the highs. High dividend yields aren't always as good as they seem to be. When you're picking dividend companies, please don't just look at this one metric. You don't have to be super smart and research into different stocks. There's a reason that ETFs and index funds exist. It makes investing for the average person completely achievable. The importance of making a habit of paying yourself first. Anybody can invest. It's not just for wealthy businessmen. You don't need loads of capital to start investing, and it's not just about people sitting in a room looking at charts and buying and selling within the same 1 hour window. There are so many different types of investments that you can make. Either find something that interests you, whether that's stocks, whether that's commodities, crypto, whatever it is, or just do a range of different things. Realize that you're on your own journey. Not everyone has the same risk appetite, capital, or interest in the same investment strategy. Investing is not a guaranteed way of making money. If you can't afford to lose it, don't invest it. And lastly, at the end of the day, it's your money. No one else is going to care about this in the same way that you do, so make your own decisions. And obviously, do your own research. So there you have it. Those were 30 things that I wish I knew before I started investing that would have really helped me out. Of course, I know these now, nearly 3 years into my investing journey, but I hope this helps someone out there. And if you've got anything that you want to add, please drop them in the comments below. And if you're looking at my t-shirt right now thinking, wow, that's pretty cool, well, you can actually get this. It's on sale now in 6 different colors. I'll leave a link in the description. Until next time, thank you for watching and happy investing.